Our two companies are Ford Motors and General Motors. This case was done by Kelly O'Brien and Jamie Vu. Who are our shareholders? General Motors has 1.57 billion shares outstanding, while Ford has 3.85 billion shares outstanding. The top 10 institutions for General Motors own 16.30% of their shares. Some of the top institutions are Capital Research Global, JP Morgan Asset Management, and the Vanguard Group. Ford's top 10 institutions own 26.10% of their shares. Some of those top institutions are Evercore Trust Company, the Vanguard Group, and Wellington Management Company. Why do investors care about our cost of capital? There's no perfect ratio that works for all companies. Sometimes you have to increase your debt ratio to lower your cost of capital. Cost of capital is important to investors because it helps determine if they should invest into that company or not. All investors want good returns, and in order for a company to give out good returns, it must be able to minimize its cost of capital. What is our cost of debt financing? The pre-tax cost of debt financing can be estimated by adding the default spread to the risk-free rate for each company. For the pre-tax, General Motors is 2.40, Ford is 3.30. The after-tax, you can get that by getting the pre-tax cost of debt times 1 minus your tax rate. In this case, General Motors and Ford both are at 35%. General Motors is 1.56 after tax and Ford is 2% after tax. What is our cost of equity financing? Based on General Motors and S&P 500 5-year stock returns monthly, General Motors beta is 1.95. Ford and S&P 500 5-year stock returns monthly has a beta of 0.135. General Motors has a beta of more than 1, which means that it's more riskier. Ford, on the other hand, has a beta of less than 1, which means they are less riskier and they move less than the market. What is our overall cost of capital? General Motors' current cost of capital is 9.15% and Ford's cost of capital is 10.35%. Based on our analysis, both companies can do better if they increase their debt ratio. They will lower their cost of capital. Could we lower the cost of capital by changing our capital structure? General Motors' current debt ratio is 4.10% and its optimal is 20%. With 4.10% debt ratio, the cost of capital is 9.15%. If they increase their debt ratio to 20%, they can actually lower their cost of capital to 8.72%. Ford's current debt ratio is at 2.72%. while its optimal is 30%. With Ford's current debt ratio at 2.72%, their cost of capital is 10.35%. If you increase their debt ratio to 30%, they can actually lower their cost of capital to 9.53%. How would a financial restructuring affect the value of our company? General Motors' current debt ratio is 4.10%, while its optimal is 20%. If they increase their debt ratio to 20%, they will increase their value from $45 billion to $48 billion, which is a difference of $3 billion. Ford's current debt ratio is 2.72%, and its optimal is 30%. If they increase their debt ratio to 30%, they would increase their value from $51 billion to $57 billion, bringing in $6 billion more. For both General Motors and Ford, if they optimize their debt ratio, it would be a positive effect for both companies. Would more debt create unnecessary risk? General Motors' current debt ratio is 4.10% and its optimal is 20%. Ford's current debt ratio is 2.72%, while its optimal is 30%. There would be an increased risk while taking on more debt for both companies. However, the reward and benefits may outweigh the risk because they both are still below their optimal. Both companies could increase their values, allowing them to grow and make more money and fund new projects if they did increase their debt ratio. Is our stock price fairly valued? There is no perfect calculation to determine if a stock is of fair value. The reason being is that the calculations need to be based on future estimates. That being said, there are still reliable ways to calculate fair valuations at reasonable ranges. This can allow investors to make educated long-term investment decisions. Free cash flow is the cash flow available to all investors of a company. There are 3 ways to calculate the free cash flow, and we chose the net operating profit after tax. We then use horizon value at 5% growth rate, each company's cost of capital, and the present value of our free cash flow to assess our total enterprise value. We then divided the total enterprise value by the company's number of shares to calculate the future stock price. This allows us to best assess if the stock price was over or undervalued. The stock price for General Motors as of September 30th, 2012 was $25.88, which is a lot higher than our analysis of $10.96. Based on our analysis, the stock is overvalued. The stock price for Ford Motors as of September 30th, 2012 is $11.37. According to our analysis, the stock price is $7.04. This also suggests that Ford's price is overvalued.